Have you ever seen the exact same asset cost $12 more on the other side of the world? In the age of high-frequency trading, where algorithms level prices in nanoseconds, this shouldn't exist. It is economically impossible. Market laws dictate that if gold is cheaper in London than in New York, a trader buys in London, sells in New York, and pockets the risk-free profit. This mechanism is called arbitrage. It is the gravity of the financial world. It keeps the system in equilibrium. I'm Greg, and here's why gravity just turned off. Look at these numbers. On the New York Mercantile Exchange, Comex, an ounce of silver is trading at 72.15s. At this exact moment, right now on the Shanghai Gold Exchange, SGE, that same ounce of physical metal is changing hands for $84.30. The gap is $12. The spread is nearly 17%. Arbitrageurs should have closed this gap in seconds, banking billions, but they aren't doing it. The chart isn't flattening. The gap is widening. Do you know why? Because you can no longer get the metal out of London. The floodgates are closed. What you're seeing on your screens is not a market anomaly. It is a crime scene. The global silver market has officially snapped in half, and the western half just died. To understand why the global financial system woke up in a different reality this morning, we need to go back 72 hours to the Shanghai port terminal. According to the shipping manifests confirmed by Lloyd's List intelligence data, 3 Panamax-class vessels, chartered by a consortium of Chinese banks, arrived empty. They were supposed to deliver 1,500 tons of silver from London vaults as part of EFP operations, exchange for physical. EFP is the circulatory system of the precious metals market. It is the mechanism that allows major banks like JP Morgan or HSBC to swap paper futures contracts in New York for physical metal in London. For decades, this worked flawlessly. If Comex was short on silver, they simply pulled it from London and rewrote the title deeds. It created the illusion of infinite liquidity. It made it seem like there was enough silver for everyone. But on December 21st, 2025, that illusion smashed into physical reality. The Bank of England and the London Bullion Market Association, LBMA, quietly halted shipments. The formal excuse? Logistical congestion. The real reason, whispered across trading floors in Hong Kong and Singapore, is far more terrifying. The London vaults are empty. We have been warning about this for years. We called it the drain to the east. Since 2021, Asia has been systematically draining physical silver, leaving the West with paper IOUs. But the West was too busy playing with derivatives. Western banks built a system where for every one real ounce of metal there are 300, 400, sometimes 500 paper ounces. This worked as long as the paper holders didn't ask for the metal. And now the moment of truth has arrived. The Shanghai Premium, the price difference between China and the world, began to climb back in September. At first, it was $1. Traders rubbed their hands. Great arb opportunity. Buy London, sell China. They started scraping the bottom of the LBMA warehouses. But the buying volume in China turned out to be so colossal that the stream of metal turned into a tsunami. The industrial giant, China, devouring 60% of the world's silver for solar panels and EVs, stopped looking at the New York price. They need the metal, at any cost. When the price in Shanghai broke $80, while New York was stuck at $70, arbitrageurs tried to grab the last bars from JP Morgan and Brink's vaults in London to ship them east. And that's when the doors slammed shut. Insiders report that on December 22nd, 3 major market makers were denied physical metal withdrawal from warehouses in the London suburbs. They were offered cash settlement with a 5% premium. This is unheard of. This is a technical default. If you keep money in a bank and the bank says, we can't give you your cash, here's a discount coupon instead, you know that bank is insolvent. That is exactly what happened to the LBMA. But the market didn't react with panic. It reacted with a split personality. There are now 2 silvers. The first is Western silver. These are digits on a Bloomberg terminal. These are Comex futures traded by algorithms. This silver costs $72. You can buy it by clicking a button, but you cannot touch it. It exists only in the cloud of derivatives. The second is Eastern silver. These are physical 1,000-ounce bars sitting in warehouses in Shanghai, Dubai, and Mumbai. This silver costs $84, and that price is rising every hour because that is the price of real scarcity. Let's break down the mechanics of the catastrophe. Why didn't the Comex price skyrocket to match Shanghai? Why is it only $72? This is a paradox that confuses rookies. When it becomes clear there is no physical metal, the bullion banks holding massive short positions are trapped. If they let the price on Comex rise to the real level of $84, they will face margin calls in the trillions. They would go bankrupt instantly. So they do the only thing they know how to do. They sell even more paper contracts. They are printing electronic silver, flooding the market with non-existent supply to hammer the price down. They are trying to convince the algorithms that there is no shortage. It is a desperate attempt to put out a fire with gasoline. The wider the gap between the paper price, $72, and the metal price, $84, the faster the real metal is drained away. Smart money sees this discount. Imagine a car dealership has two identical cars. One has a sticker price of $84K, the other $72K. Which one do you buy? You buy the one for $72K. But when you go to sign the papers, they tell you, the car isn't here, but you can hold a photo of it. That is the essence of today's situation. The $72 you see on the chart is the price of a photo of silver. The $84 in Shanghai is the price of the silver itself. Last night, we gained access to an internal report from one of the logistics operators working with Comex vaults in New York. The numbers are shocking. In the registered category, silver ready for delivery, there are officially 30 million ounces listed. But a fine print footnote indicates that 85% of this volume has the status of pledged or is encumbered by lease agreements. This means the real free-floating metal that you can load onto a truck and drive away with. There is less than 5 million ounces left on the world's main exchange. That is less than the annual consumption of Samsung alone. It is a rounding error. It is zero. And that is why arbitrage is dead. Arbitrage only works when you can buy low and guarantee receipt of the goods to sell high. If there are no goods, arbitrage turns into Russian roulette. No one wants to risk capital buying a future at $72, knowing the exchange could declare force majeure and forcibly close your position at the purchase price, robbing you of profit while the real price flies to 100. China figured this out first. Beijing's Commodity Security 2025 Directive effectively banned silver exports. But they went further. Chinese state-owned companies began aggressively buying silver directly from mines in Mexico and Peru, bypassing London and New York completely. They pay a premium. They offer long-term contracts at Shanghai prices, not Comex. Think about what this means for a mining company. An American banker comes to you offering to buy your ore at the exchange price of $72. Right behind him walks a representative of a Chinese consortium who puts a contract on the table for $84 with a prepayment in yuan. Who do you sell to? The flow of raw materials is reversing. The tributaries that fed the Western financial system have dried up. Silver no longer flows to New York. It flows to Shanghai, to India, to Turkey. The BRICS nations have created their own closed loop for precious metals, and inside that loop, price is determined by supply and demand, not by speculation with 100-to-1 leverage. The situation for Western banks is catastrophic. They have delivery obligations to industrial giants, Tesla, Apple, Raytheon. These companies don't need dollars. They need physical silver to make missiles, chips, and batteries. They come to the bank with a futures contract and demand delivery. The bank looks into an empty safe. The bank calls London, send metal. London answers, the gate is locked. The bank looks at Shanghai, where there is metal, but it costs $84. To fulfill the obligation, the bank must buy metal in China with a loss of $12 on every ounce, plus shipping, plus tariffs. These are billion-dollar losses. So they pretend nothing is happening. They pin the price on Comex at $72, hoping the panic subsides, hoping someone will sell. But nobody is selling. Holders of physical metal see the spread. Why sell to a bank for $72 when the dealer around the corner will buy from you for $80? The secondary market in the US and Europe has already decoupled from the exchange. Try finding an American Eagle coin for $75. You won't find one. The real street price has already caught up to and surpassed Shanghai. The Comex exchange has turned into a price museum, a display window with nothing behind it. But the worst is yet to come. What happened this morning with the spread blowout is just the first tremor. The main shockwave hits on the option's expiration date, which lands in exactly 48 hours. 48 hours. That is how much time is left until the December option's expiry on Comex. And this is the point of no return. Usually, this is a routine event, but today, we are in the epicenter of what traders call a gamma squeeze. Watch closely. A massive amount of put options, bets on the drop, and call options, bets on the rise, are clustered around the $75 mark. This is the death line for the banks. If the price breaks above $75 and heads toward the real Shanghai price of $84, the market makers who sold these options will be forced to hedge their risk. How? By buying futures. This creates a feedback loop. Buying pushes the price up. The rising price forces robots to buy even more. It is a mathematical avalanche capable of wiping out any bank's balance sheet in 15 minutes. To prevent this, banks are currently throwing everything into the furnace. Reputation, hidden reserves, political influence. They are artificially holding the price at $72, creating an illusion of stability. But this stability is a lie, and the industry is starting to realize it. While financiers stare at charts, the real world is starting to grind to a halt. At 9:30 a.m. Pacific Time, we received confirmation that one of the largest EV manufacturers in the U.S., we won't name names, you know who, sent a force majeure notice to suppliers. The reason? A shortage of silver-based industrial pastes. A modern electric vehicle is essentially a chunk of silver on wheels. It's in the contacts, battery management systems, screens, solar roofs. For years, auto giants operated on a just-in-time basis, holding zero inventory. They believed they could always buy metal on the exchange. This morning, their procurement departments tried to buy 2 million ounces to close their quarterly quota. The exchange offered them paper certificates, dealers suggested waiting 6 months, and Chinese suppliers offered metal, but only on the condition that production moves to Shenzhen. Do you see the irony? The West suppressed silver prices for decades to subsidize its green revolution. Cheap silver made solar panels cheap, but by suppressing the price, they killed mining production. No one invested in new mines at $25 an ounce. Now that the shortage has turned physical, cheap silver is gone forever. The West's green revolution just hit the concrete wall of reality. But the hardest hit isn't coming from the factories. It's coming from private investors, the little guys that Wall Street always ignored. Last night, hedge funds, family offices, and high net worth individuals began a mass conversion of their unallocated accounts into allocated ones. What's the difference? An unallocated account is when you give the bank money, and the bank promises it has silver somewhere. You are just an unsecured creditor. An allocated account is when specific bars with serial numbers become your legal property, are set aside on a separate shelf, and cannot be touched by the bank. The banks sold 100 times more unallocated silver than they have bars in the vault. This is called fractional reserve banking. And now a bank run has started, only instead of cash, people are demanding bars. What happens when 100 people come for the same bar? Price ceases to matter. Only possession matters. Insiders from Zurich report that Swiss refineries are running 3 shifts, but the order book is filled until 2027. If you don't have the metal in your hands right now, you don't have it at all. We are witnessing the death of an era where the West could dictate prices for resources it does not possess. The $12 arbitrage gap between Shanghai and New York is not a glitch. It is a divorce. The East has filed for divorce from the dollar-based pricing system. Shanghai says, we have the metal and we know what it's actually worth. $84, $100, maybe $200. New York says, we have derivatives and we want the price to be $72. The market has made its choice. The metal has flowed to where it is valued. When the options expire in 48 hours and the smoke clears, we will likely see one of 2 things. Either Comex declares cash settlement only, officially admitting the exchange is no longer a place for commodity delivery. That would be the end of the futures market as we know it. Or an instant reset occurs and the price in New York skyrockets overnight to close the spread with Shanghai. The gap from $72 to $84 will be closed in a single candle. Those who were short will be obliterated. Those waiting for a pullback to buy will be left on the platform. In 1965, President Lyndon Johnson, while removing silver from U.S. coinage, said, "Silver has become too scarce to be used as money." He was wrong. Silver is money. Paper is just a promise. Today, December 25th, 2025, the world remembered this truth. Arbitrage is dead. The physical blockade is real. The window of opportunity is closed. If you're watching this and you own physical metal, hold it. Do not trade it for fiat confetti, even if they offer you $100. Because in a world where supply chains shatter and exchanges collapse, an ounce in your hand is the only sovereign territory you have left. Shanghai won, the dollar lost. Welcome to the real world.